Sure.
Okay.
Hello, everyone. Thank you. You guys, Owen, John, doing well? Okay? All right. Well, thank you all for being here. It's a real delight to speak on this panel, or moderate this panel, rather. And I think one of the things we keep hearing about in this conference is how the energy transition in particular is creating an exponential demand increase in the minerals critical to the energy transition. The International Energy Agency put out a report recently, and they spoke about the looming mismatch between climate ambition and the minerals that allow the world to realize that ambition. This mismatch is causing a lot of companies and countries to rethink their respective mineral endowments and looking for new opportunities all around the world. And I'm absolutely delighted that we have a panel of experts today that can speak about this investment climate. In particular, how they view the concept of what countries who may have traditionally been considered under conventional views as high risk. What can those countries do to attract investment given this demand scenario? Let me just quickly introduce our panelists. It's a distinguished group. We have Matt Fifield. I may be mispronouncing your name, I'm sorry.
Fifield.
Fifield from Pacific Road Capital, a leading private equity fund focused on minerals, metals. Mr. Abdulaziz Barakat Hamwah, Vice Chairman and Chief Executive Officer of Modern Group. Andrew Irvine, Legal and Corporate Engagement Director for the Extractive Industry Transparency Initiatives. Mr. Owen Hegarty, OAM, Executive Chairman, EMR Capital. And Professor John Sfakianakis, Director of Economics Research, Gulf Research Center. A distinguished group indeed. I'd first like to turn to Dr. John. I'm calling you that because I don't want to pronounce your last name again or mispronounce it, so apologies. Dr. John is a distinguished economist focused on the MENA region. He's an advisor to governments, he's an advisor to corporations. Given your specialized experience across the region, how do you view risk? And how do you see it as perhaps we should be thinking about risk in a new way or a different way than perhaps conventional thinking may suggest? Please.
Thank you, Frank. Great honor to be with you, and I would have been delighted to be physically in Riyadh. It's unfortunate that sometimes the pandemic has its own doing and effect on people. As you said quite rightly, I think risk has to be reassessed in a way that brings into the fold the dynamism that countries go through and the change that a lot of these countries, especially in the Middle East, see. And I think we need to look at risk in the post-COVID era very differently than what we have done in the pre-COVID era. The matrices that we apply, which is the macroeconomic versus the political, has to be reassessed. And what do I mean by that? I would say that there are certain risks that are very time sensitive, and I think our way of managing that appraisal of time has elapsed with the advent of COVID. So time has to be reassessed, and we need to appraise and look at risk in a more time efficient way. We also need to do away with stereotypes, and I think that the Middle East, but other regions are very well versed into stereotypes that get defeated all the time. So one common stereotype when risk looks at the Middle East is that the Middle East is often perceived with instability and violence. Well, it is at times unstable, but I would say the Gulf, and within the Gulf region, Saudi Arabia, is the opposite of being unstable. It is probably the most stable in the region. Then we need to also have divergence between the region, meaning the Middle East, and outside of the Middle East. Not everything is the same. And then again, when we look at the Middle East, there are different elements of differentiation. So I often tell my colleagues that Paraguay and Uruguay are not the same. They might sound the same, but they're totally different. Uruguay being more advanced, Paraguay a little bit less advanced, and still trying to do a lot to change its economy. So Saudi Arabia is not the same as Morocco. Egypt is not the same as Jordan. Having said that, there are certain common things that are applied to when we look at the region and the Middle East, and there are certain things that are different. So I would differentiate the Middle East in terms of the net exporters of energy versus the net importers of energy. So those who produce energy and export it, and those who are import dependent. But within that, there are certain characteristics that define many of these Middle Eastern countries. I would say that energy price shocks is quite important for the energy exporters. And it's not the case for countries such as Jordan, Tunisia, and Morocco. But then again, there are common themes such as cyber attacks that are quite important and essential to countries such as the UAE and Saudi Arabia. But yet again, they are different for those that include Yemen, Sudan, and Iraq. One common theme that one needs to look when we see risk in the region is also the issue of inflation, which is a recent arrival in our midst. Inflation 2 years ago was not something common in the Middle East, but now it is. Water crisis is something that should be with us for many years to come. And also the issue of employment and underemployment for many countries in the region. And I would then urge you that although we do mention that governance is very important, give more credence to the countries of the Middle East, and especially a country like Saudi Arabia that has been very high-end on governance, economic reform, stability, and the ability to produce and have the capacity to see through the implementation of economic reforms. And I will end with this. In my world of emerging markets, I could not see anyone other than Saudi Arabia who is pushing with the impetus of economic reform and conviction and commitment than the Kingdom of Saudi Arabia. Thank you, Frank. The floor is back to you.
Thank you very much, John. Well put. Appreciate the perspective and highlighting that we have to differentiate risk, countries, development, but also pointed out some cascading risks in the context of cyber kind of affects us all. Interesting perspectives. I'd like to turn also to you, Owen, given in particular, your considerable experience working in diverse jurisdictions for multiple companies around the world. You're an investor. How do you see risk? Do you approach it with a particular screening criteria? Could you speak to that a little bit, please?
Yes, okay. Well, thank you very much, Frank, for that introduction. Thank you to the organizers, and thank you very much to the Kingdom of Saudi Arabia for its sponsorship here. And you've got a terrific panel here, so I won't take up very much time. And Professor John has already given you some very, very wise remarks there. But look, in terms of risks, Frank, all the usual risks are available to us here, right, in our industry as we go forward, whether it's the macro risks or the micro risks type of thing. But one thing very important that you said up front, the background here, the macros, the longer term here, we are still in for multiple decades here of economic growth. We're going to see that. You're going to see continued growth of commodities, and led by China, followed by India, followed by Africa, other developing countries, Indonesia, Asia, South America, and so on. So you've got all of that happening, not without its humps and bumps, of course. You're going to see the humps and bumps and disruptions and so on from time to time. But you've got a good trajectory, and then on top of that, you now have the whole energy transition thematic. Well, you know, it's no longer a thematic, it's a dynamic, in fact, and people are boasting targets out there to 2050, 2060, 2070. So we've got up to 50 years of a further booster here, Frank, in terms of increased economic growth. So from a demand perspective, you know, the risk, in fact, is on the upside here, on the demand side. Supply side is where the issue is going to be. So we are, the industry here, we are the problem. How are we going to manage the risks here to be able to continue to supply that burgeoning demand? Now, I have to say, the supply side, the mining industry has done a very, very good job when it comes to COVID, for example, managing that big risk. We really haven't missed too many beats. We've missed a few, but we haven't missed too many beats as an industry. We're ready, we're prepared, we're ready to face those sorts of emergencies, those sorts of occupational health and safety issues. So good at that. We're also very good, Frank, in terms of actually people talking about the targets for net zero, decarbonisation, and so on and so forth. We're very good in terms of actually managing the scope 1, the scope 2, and the scope 3. We're on track to make sure we do all of those sort of things. So the industry response there has been very good. It's not without risk, but it's actually been very good. And it's been very, very good in terms of adapting and adopting the new technologies, whether it's automation, robotics, artificial intelligence, digitization, miniaturization, and so on. It's very good at adopting all of those things, and it's driven by safety, it's driven by labour and skills availability, and is driven by energy pricing and availability. So the industry's actually been very good at doing all those things. So where's the issue? The issue really is, where do we get these new supplies from? Where do we make these discoveries? Where do we make the developments? The capital is available. Professor John will tell you all about that. The very, very good liquidity around the world. So where do we actually go to these places? Well, as you said, Frank, at the very beginning here in the introduction, we're going to have to go to places that haven't been down the fairway before. So in other words, they're not on the immediate radar. They're a little bit out of it type of thing. So places that we haven't been before, less popular, as they say. And you did ask, well, what is your screening? How do you go about screening as to, where you go, what you look for in particular countries and deposits and so on? Well, we in EMR Capital have a very, very rigid and thorough screening process. We call it the Rule of 8. And in terms of a deposit or a country or a project and so on, it must have the scale, it must have the quality of the grade, it must have a conventional process, it must have low cost, long life, lots of upside, it must be very attractive to the next owner as a private equity type, and it must be in a stable and secure domain. And that's where the issue of country risk really, really comes home. So you have to do your work so well, Frank, there in that stability, transparency, openness, very good governance, very good cooperation, and very good partnerships. That's what you're there for. You want to have partnerships with the governments. And it's not just the national government per se. It's also the provincial governments and And ultimately, it's right down there, Frank, with the local community. So that's where you must attain, retain, sustain your social license. You've got to build the confidence of the people whose valley you are a guest in, whose community you are a guest in. So very important to be confident that you're going to be able to get down and attain, sustain, and retain that social license. So they're the sort of things that are very important to us as we go through our business model and as we face the future. So finally, Frank, as I said, all the usual risks are available to us here. We just have to get on with our job of mitigating, managing, and working our way through them, and particularly when it comes to some of the places we haven't been before, Frank. I hope that helps.
No, very, very well put, Owen. Thank you for the perspective. The rule of 8, that's great, and I think underscoring your point, differentiating legal license versus social license is something I don't think we can speak enough about. I'd like to now turn to you, Matt. Also, you run a private investment firm. Do you share Owen's rule of 8? Maybe you have a different number, you call it or something else, but how do you see risk, and maybe where else should we pay additional attention that perhaps the conventional concept of risk we're not considering as we should?
Sure. Well, thanks, Frank. You know, look, when you think about risk originates from different spheres, but what you're actually looking for is layering of risks, and I'm going to speak to this as an investor. There's risk when you start, there's risk while you own it, and then there's risk around when you sell something. And that means that across the investment life cycle, and we'll own things for 7, 10 years, you know, probably the biggest single thing that we're looking for is predictability. If you understand what the rules are and you're reasonably certain that they're not going to change, that allows for you know, good calibration on our side, and it allows us to develop more meaningful strategies and value enhancing maneuvers and grow companies, and basically you're bringing things to light from you know, from an idea into concept. A lot of the times we're bringing projects from a development stage into production. And so the predictable processes is one of them. The other thing is really people. And if you step back, the world that we've been talking about all day long it's pro-cyclical, absolutely. We're in a place where it's not a question of demand, it's actually a question of supply. Can we supply into that? Some of that is project inventory. And actually, I would argue that the single biggest constraint that we're faced with is a mining industry that has pretty much not attracted talented young people for a long period of time. It takes somewhere between 8 and 15 years to working inside a mining company to begin to exercise judgment and understand how to navigate through issues, to problem solve, and then maybe another 10 years past that to develop leadership qualities. So what's going to be happening is the world is going to be struggling to bring on supply at a time that we're probably at an all-time low in terms of the people inventory. And so what you'll find is that, let's just call that soft infrastructure, right? So that soft infrastructure, some of that you get out of big corporate organizations. In the small and medium-sized companies, you're going to have people taking risks that they may not have experience around. So having cool hands, whether it's regulatory partners, local partners, or professional investors like myself and Owen, who've been around and seen some of the mistakes coming, it ends up being very important in taking some of those risks. But at the end of the day, with risks come opportunities. And I was thinking about this question: how do you take a high-risk country and attract investments? Well, the first thing you should do is you should take your best and brightest, and you can have them all come work at Pacific Road Capital or EMR or Trafigura or Rio or wherever. And I would say that the skill sets around investing in natural resources are very similar, but the domain expertise and the people networks are very different inside mining. It's different between bulk materials and hard rock, and they're very different thought processes about how things go. So with, there's an old saying that investment moves at the speed of trust. Okay, so if investment moves at the speed of trust, how do you attract capital? You increase familiarity. Events like the one that we're at here today are incredibly helpful for making connections that will foster great things. But then similarly, whether it's developing local partnerships or developing higher levels of familiarity, that's where deals get done. It gets done around people that you trust, processes that you trust, and it's really that trust building exercise that opens up the doors. So the framing question, if you're sitting at it from a regulator or a legislator or leadership position, is how do I increase trust in this situation in order to increase capital flows? And from there, I think all risk questions radiate.
Thank you, Matt. Really interesting insight. The soft infrastructure, it's absolutely key. I guess, of course, reflecting on this region, and one of the points that you noted was one of the industry's challenges is the people, having competent workforce, safety culture, technically focused, and they can execute. And I think what's pretty exciting from my perspective as a former diplomat and having worked in the industry before that is that this region, it's bustling. And there is this ready-made workforce. It's hungry, sophisticated people who are ready to take that on. But to your point, it's up to the industry to help bring them on that journey. And it spoke back to the earlier point about social license, and I think that's probably part of that trust exercise. I'd like to speak, turning to the industry in this region and this country in particular, Mr. Abdulaziz, you have a particularly informed view, and particularly with respect to the kingdom. Can you share your experience and whether and to what extent risk, real or perceived, might be mitigated and how that might happen or how that is happening as you see it on the ground?
Thank you. I've been involved in the risk assessment over the last 40 years. Risk assessment depends on what type of risk you want to look at. Are you going to look at political risk? Or are you going to look at the financial risk? Or are you going to look at legal risk? Or are you going to get to environment, etc.? In this region, especially in Saudi in the early 80s, when the Saudi government decided to invite investors, the biggest problem was the political risk because there was no legal structure, there is no precedent for investment. So we have started in this country from scratch. So what happened is the government have taken a lead and cover most of these requirements of risk. And they have created an industry which is the first major industry that a lot of international investment came in, which is the petrochemical industry. All the big names in this sector came into Saudi Arabia and invested. But what the government did, they did hand-holding to these investors. Any issue comes in, the government is right there to answer all these questions. In addition, they have package of investments and incentives to help. So I have witnessed this period or era for the last 30 years. I can say Saudi Arabia right now is one of the world's most successful petrochemical hub. Actually, we have one hub in Saudi Arabia last year became the world's largest hub for petrochemicals, surpassing Rotterdam and Houston. Today, for the mining industry, government doing similar action. The only difference is they are adding more incentive since it's different from the petrochemical industry. By saying this, an investor can come to Saudi Arabia. There is a mining laws. Political list is very clear. Saudi Arabia is part of the G20s. All the banks are financially rated. The government is rated. On top of this, you can come and invest while having available funding arms from the government, i.e., any mining project in the country for an international investor can secure 50 to 75% long-term funding from the government. In addition, if the project is big enough, some of the funding, government-owned funds can chip in as an equity and enabler. So by the end of the day, you will have an investment that directly or indirectly helped by the Saudi government, which is rated, I think it was rated lately according A+, and if it's not in this region, it could be AAA, because Saudi Arabia balance sheet is almost very clean. There's small borrowing, but it's very little compared to GMP. So I think today this country can attract a lot of investment for a technical how purpose and not because of the funding needs. So any investor who gets technical know-how, I think his funding requirement will be very little compared to other places. And I think all the legal issues, including the laws, are very clear and straightforward. That's my reading for this. And I think the mining industry in Saudi Arabia will witness a boom, much more than what happened in the petrochemical before, because of the experience that we have learned from doing the petrochemical transaction.
Thank you. Thank you for that perspective. It's yeah, it's an important analog here, where you mentioned that the country's starting from scratch, but not really. There's a model of success. They have a playbook, and they're executing that, and they're building off of that. Now that's really important, and that's considerable government level of support. I'd like to now turn to Andrew. Speaking of building on playbooks of success, I mean, you're focused at EITI, the Extractive Industry Transparency Initiative. You talk about global governance issues and transparency. Could you speak a little bit about how you see that issue? And in particular, we're supposed to be talking about attracting investment. Is there a correlation in your view between investment and some of these good governance concepts? Thank you.
Thanks, Frank, and certainly thank you to the other panelists for their insight on this topic, and thank you to the Kingdom for hosting us today. There is a direct correlation between government standards and investment, and to a large extent. Yesterday, for those who were able to attend the ministerial roundtable, the World Bank indicated governments are the single largest determinant of where mining investments are made. So it's no coincidence that the jurisdictions that are attracting mining investment are those with stable and transparent regulatory regimes. I believe it's around 50% of all new exploration investment goes to Canada, Australia, the United States, and to a lesser extent, Chile. Uncertainty is a confidence killer for mining executives and investors. So that's frequent changes in policies, fluctuating tax regimes, the opportunity for corruption, inefficiencies, government or civil society issues and their non-involvement in issues, etc. These are all very detrimental to investment in a country. Mining investors, they want to see good governance, level playing fields for mining companies, and clear and stable rules for investment. At the EITI, the Extractive Industries Transparency Initiative, where I work, we currently work with 56 countries around the world, helping them to develop and improve governance in oil, gas, and mining. We also work with around 70 of the leading oil and gas and mining companies who support our work in countries, but also adhere to a set of standards concerning their public disclosures and transparency practices. Countries who are interested in improving their natural resource management, often spurred by trying to attract investment, sign up, apply to become an EITI implementing country. Once they are admitted, they have to adhere to a written standard, which is the EITI standard, which is the global standard for the good governance of oil, gas, and mining. I don't need to go into the specific details on the EITI standard, but I do have a copy here if any of you are interested. But Frank, you asked, what does good look like? What is best practice in this area? And certainly, from the viewpoint of the EITI, and we do work in many high-risk, quote-unquote high-risk countries. Good governance is all aspects of the mineral economy being at the table. That includes government, companies, and civil society all being involved in mineral resource governance. Good looks like clear and stable and published regulatory regimes, and that includes providing an understanding of the state's relationship with state-owned enterprises and their involvement in the mining sector. Good looks like governments and companies and civil society knowing who they're doing business with, or as we call it, beneficial ownership transparency. Good looks like the public knowing the terms under which their natural resources are being sold, or contract transparency. Good looks like the taxes and payments from mining companies being transparent, people understanding what those are and where they're going, and then making sure they're received by the government, and then understanding how they're distributed, including back to communities and back to regions that are impacted by mining. I think it was a point made by ICMM and the Natural Resource Governance Institute, also at the Ministerial Forum, but good governance will be the key factor in mineral resource development in this region and development of the minerals here. And I can't echo that point enough, but governance is vital to attracting investment in this region. So if you have any interest in improving, I certainly welcome you to look up the EITI, both for companies and countries, and we're certainly willing to support you in that journey. So with that, Frank, hopefully we have some time for discussion.
Thank you. Peter's telling me we don't, but thank you for that. This is an incredibly important panel, and I guess, Matt, you made the comment that investment moves with the speed of trust. I think that's an important point. I'd also like to underscore the other point that you raised about the layering of risk, and that it's a continuous journey, and Owen spoke to that as well. Your job is to build up something, and with an idea to sell it to somebody else. It has to be something someone wants to buy, and that means to mitigate that risk. And the governments, of course, Abdulaziz, have a crucial role to play and can meaningfully mitigate risk. But it's also up to that social license as well, and making sure that we all know the rules of the game. The Earth's crust is blessed with good rocks everywhere, and it's really what are the conditions above the ground that considers whether it's a risky project or not. And so I think, in terms of this region has the rocks, and it's developing the appropriate conditions to facilitate those levels of investment. So thank you, panel. Thank you, Future Minerals Forum. This has been a wonderful